Coming up on the programme, we'll take a closer look at India's commercial real estate space. Mindspace REIT CEO joins us next. India's Mindspace REIT is out with its fourth quarter earnings. Revenue rose 31% on year, while net operating income jumped more than 37%. Firm also posted its highest ever quarterly distribution of 6.64 rupees per unit, reflecting improved cash flows. Leasing momentum remains steady, with gross leasing of about 3.7 million square feet during the quarter, while portfolio occupancy edged up nearly 96%. Ramesh Nair is with us to talk through those numbers, CEO and Managing Director of Mindspace Business Parks REIT. Ramesh, welcome to the programme as always. FY26 was a standout year. What's the single biggest driver behind that performance?
So, Sri, thanks for having me on your show. We've had a very good quarter again, highest ever gross leasing, more than 3.5 million square feet. We pre-leased two of our buildings totaling close to 2 million square feet. We also have the highest ever committed occupancy at 95.7%. Very strong re-leasing spread again this quarter, close to 40%. Our biggest park, Madhapur in Hyderabad, is at 99% occupancy. Our second biggest park in Airoli West Gigaplex, that's again 99% occupancy. So 10 out of our 14 parks today have either 99 or 100% occupancy. What's driving it? It's obviously the market. India office market has been doing exceptionally well. In the last 3 years, we've seen the office market go up 18%, 17%, and 15%. And this quarter, the first quarter, calendar quarter of this year, in spite of all the war challenges, the market again went up 7%. So the demand is driving the market.
So in broad terms, momentum in FY26, can that be sustained into FY27, Ramesh, given the balance of risks?
So there are some risks emerging, Sri. So we are seeing a little bit this demand for data center, which is going up. We have started seeing some amount of oil price surge impacting inflation. This will have an impact on input costs credit. In the last 4 months, we've seen construction costs go up by around 6.5%, mainly in aspects like RMC, cement, tiles. Typically, the annual escalation of construction cost over the last 3 years before that used to be around 3%. But the positives, rupee depreciation makes India more attractive to GCCs. Rent in dollar terms remains the same. We have seen this also during when the Ukraine war happened in 2022, that we should be ready for pent-up demand. And there have been a few cases I've heard. We've fortunately not been impacted, but there's been a few cases where travel restrictions and airspace disruptions have had an impact on transaction timelines. And also companies typically in these kind of environments have a cautious capex deployment. So some of these cases I've heard.
Interesting. And just while we're talking about this theme of global uncertainty and how it's playing out or how it could play out in the business, how resilient is demand from multinational clients and tenants, Ramesh?
Exceptionally good today. If you look at the GCCs in the country, we have 2,900 plus GCCs in the country, which employ close to 1.9 million people. Around today's revenues from GCCs in India is close to 65 billion. This last year alone, out of 2025, 33 million square feet was taken by GCCs, which is 40% of the overall demand. We believe by 2030, this 2,900 number will become 4,400. The number of people from 1.9 million will become 2.8 million people, and revenues, which is currently at around 65 billion, will go to around $105 billion.
Let's turn to leasing and demand, and you clocked 7.1 million square feet of leasing this year. How sustainable is that pace?
It all depends where the market is heading. The four markets where we have a presence, Hyderabad, Chennai, Mumbai, and Pune, all of them have been doing well. Demand outstrips supply in a market like Hyderabad, where we saw rentals go up over 20-25% in the last year. We're confident about the performance of all these four markets this year, Sri.
Hyderabad is an interesting case. Pre-leasing, 2 million square feet there. Are tenants locking in early out of confidence or fear that rents may rise even further?
Very interesting data point on Hyderabad. Last year, out of all the GCCs who came to India, 46% of them choose Hyderabad, which was the highest in the country. And we are seeing that impacting our portfolio. Today, we have three buildings which are under construction in Hyderabad. One is a 600,000 square feet building, which is fully pre-leased. Second is a 1.5 million square feet building, which is again fully pre-leased. And third is a 1.7 million square feet. Again, 1.5 million square feet of the 1.7 million is fully pre-leased. So definite tailwinds from the GCC sector helping the overall Hyderabad office market.
Let's bring in the financial performance aspect of the business. NOI up over 37%. How much of that is operational versus cyclical tailwinds? And again, is that sustainable?
That's a very operations and execution focused business. Instead of looking at just the last one quarter, let's look at what's been happening over the last 2 years. So our in-place rent used to be 2 years back around 67, 68. Today, that's touched 80 rupees. In the last 2 years, we have seen a CAGR of rentals going up across the portfolio by around 8%. Again, revenue CAGR in the last 2 years has been 22%, and NOI CAGR has been around 24%. This definitely helped us from taking our NAV today from 370 to 527. Again, DPU growth has also been very good, and our share price in the last 1 year has gone up from 379 to 470, which is again very good in our equity market, which is given 0 to 3% return over the last 12 months. We're very happy to report that our total return, including our distribution, has been close to 30%.
And NAV, before we get on to distribution, which is another interesting aspect of the business, NAV up 9%. Do you see further re-rating potential there, Ramesh?
Definitely, Sri, especially in the markets we are in. Market rentals are going up like we saw in Hyderabad, like we're seeing in Chennai, in all the markets, whether it's Madhapur, in our assets in Raidurg, in our Airoli West, Kharadi, Nagar Road, all these places we have seen rental rates going up. We're also seeing cap rates compressions happening in most markets in India, and we will benefit from both these aspects.
And record distribution, can investors expect this to continue? Again, given the challenges in the domestic economy?
We typically don't give guidance on distributions, Sri, but in the last four quarters, we have given distribution, double-digit distribution between 10 to 20%, and we hope to continue that.
I see. And you're doubling down on Chennai. What makes that market so compelling for Mindspace?
3, 4, 5 aspects. When we studied the market in Chennai, we have done 2 large acquisitions totaling close to 5,500 crores. We realized that Chennai has the lowest vacancy rates in the country at 7%. The country average is around 14%. We also looked at which are the most happening micro markets in the city. And the micro market where we have picked up two assets, the PTR Road micro market, where again vacancy rates were 7%, and institutional vacancy rates were like close to negligible. These are the reasons we picked up the asset. Another data point on Chennai, we saw Chennai, which pre-COVID used to be a 3 million square feet net absorption market. Today it's become a 6 million square feet net absorption market. So these are some of the aspects because of which we have decided to acquire these two assets. And with this, our overall portfolio in Chennai, Chennai used to be 3% of our portfolio, becomes 14% of our portfolio.
Ramesh, just a final question on the structural shifts related to the future of work. Return to office momentum. Has that fully played out, or is there more upside to that narrative?
See, we don't come across work from home as a conversation over the last 1 year. So it's behind us. Today, most of our campuses, employees' attendance rates are over 80%. So no longer an issue.
Ramesh, always great catching up with you. Thank you very much indeed for those insights on the business. Ramesh Nair there from Mindspace Business Parks REIT. Thank you. Quick check on